Well, happy Friday, everyone. Homecoming Friday, no less. Big plans for the weekend. I'm gonna work on auditing. Yeah, work on auditing. Gotta prepare for the exam because the work never stops, unfortunately. But I have confidence in everybody in this room. I believe that you all can do well. I believe that you can do well. That's it. That is, of course, that we get through this homework, which we've got to do to get through this homework. So let's go ahead and get started. I guess before we get started, I do want to remind you. I've been very, very remiss on making sure I follow up on this, which that's my bad. But to be fair, I've got a lot going on, cheeseburgers to eat and stuff like that. Yeah. With or without kraut? Oh, crab. Oh, with lobster, you mean?
Yeah.
Lobster. Hey, that's a once in a lifetime event. And if I could repeat it, it wouldn't be a special. So, for everybody who doesn't know, I'm on social media today, like the Truman School of Business, and I talked about a cheeseburger I had covered with lobster. And if you like cheeseburgers and you like lobster, it's as great as it sounds. If you like neither of those things, well, shame on you, first of all, okay? But secondly, it's probably not that good, but it was delicious. It was not the best cheeseburger I've ever had. It's not the best lobster I've ever had, but combined, it was the best lobster cheeseburger I've ever had. The only lobster cheeseburger I've ever had. So yeah. I'm getting distracted. Yeah. So we do have our group project at the end of the semester. We still have one group formed. We still need to form the other groups. I said I wanted to get that done by the end of this week, but I've not been very good about following up. So if you have people that you're going to be in a group with, please let me know. Please email me. The group that's already formed, you know who you are, so you don't need to worry about that. But everybody else, if you don't have any preference, don't worry about it. I'll put you in a group. That was my disclaimer, and I'll make sure I follow up more diligently next week after the exam so we get that set. All right, we have 3 chapters to go through, and let's go ahead and kick it off. So we're going to start with chapter 17. Chapter 17 was about closing procedures, about audit closing procedures. And I know it's been like over about a week and a half since we covered it, but hopefully you didn't find it too onerous. So an auditor should request that an audited entity send a letter of inquiry to those attorneys who have been consulted concerning litigation claims or assessments. The primary reason for this request is to provide what? So this is our legal letter that gets sent to the lawyers. And what do we know about the lawyers? Are they representatives of us, the auditors, or are they representatives of the clients? Yeah, so they're not going to tell us any information that we don't already know. So anything that basically says, hey, they're going to provide us with additional detail. They're not, because they're dirty, stinking lawyers. Okay. Yeah, I said that, Professor Templeton. You remember that. Okay. So yeah, Scott ETR and I are good terms. Don't worry, okay? Just because I talk trash about him in class doesn't mean I don't like him, okay? But anyway, the lawyers have obligations to fulfill the responsibilities towards their clients, so they're not going to volunteer any information. So if we know the information, they can provide us context for it, which we call that corroboration, which means our answer is corroboration of the information first by management concerning litigation claims and assessments. It's a good way to corroborate information, not a good way to obtain information. All right, number 15. An auditor has issued an audit report that was dual dated for a subsequent event occurring after the date on which the auditor obtained sufficient appropriate evidence, but before the issuance of the financial statements. Okay, so this is one of those situations where the audit report and the financial report date or the issuance of the financial statements are not the same date. So there was a gap in time, and during that period of time, a subsequent event occurred. We do still have responsibility for that as auditors. We are responsible for that event. We have 2 options. The first option is to basically change our audit report date. That's extending liability. That's basically saying that we're going to be responsible for everything up to that point in time. This is the other one. This is the dual dating. We're saying we're going to have 2 dates. We're going to have the original audit report date and then the date the subsequent event was cleared. Okay, that's a dual dating item. What does that do? It limits our liability, or in more appropriate terms, it limits it to the specific event referenced. That's basically what we're doing in that situation. All right, question number 21. Which of the following events occurring after the issuance of a set of financial statements and the accompanying auditor's report would be most likely to cause the auditor to make further inquiries about the financial statements? So keep in mind that once the financial statements have been issued, we generally do not have any responsibility of that as auditors. The financial statements have been issued. We've done our job. That's it. The only situation in which we would have a responsibility would arise when the auditor identifies something that's relevant to the period under audit. Okay. So basically, we can go through these answers and kind of sort through them. Technological development in the industry that could affect the future ability to continue as a going concern. That's not relevant to the current period or relevant to the period under audit, so we don't need to worry about that. It's something concerning, but it's not not an obligation of ours. Entity sale is a subsidiary that accounts for 30% of the entity's consolidated sales, again, after the period of audit, after the financial statements, okay? It's not relevant. Discovery of information regarding a contingency that existed before the financial statements were issued. That is relevant to the period under audit. That's something that we should have been aware of when we were performing our financial statement audit. As such, we have a requirement to go back and review that information to make sure that we don't have to change our opinion, or the client does not have to issue any changes to their financial statements. This would be our responsibility, and this is our answer C, but let's look at D. The final resolution of a lawsuit explained in a separate paragraph of the auditor's report. We don't have a responsibility for resolution of lawsuits if they occur after the financial statement issuance, only up until the financial statement issuance. So C is our clear answer there. Let's move on to chapter 18. What do you say? Or we could ask more questions on chapter 17. We didn't do any homework on that, but yeah, it's always good to review. Does anybody just ever finish their assignment? Just kind of like, I really want more questions. No? Okay. All right. Had to ask. Just maybe thought there was an appetite or a hunger for audit. All right. Auditor includes a separate paragraph in an otherwise unqualified financial statement audit report to emphasize that the entity being reported upon had significant transactions with related parties. The inclusion of this separate paragraph. So, which sounds like an explanatory paragraph, which just, I don't know that I mentioned this, but I do want to put this in context. If you talk about this from a private or a non-issuer audit, which remember those are under ASB auditing standards. If we talk about that, it actually uses a different term. It's called an emphasis of matter paragraph or an other matter paragraph. The only reason I bring that up is you might encounter that in your reading. It's effectively the same thing as an explanatory paragraph. It's just a different terminology. So this is asking, which would this be appropriate as an explanatory paragraph? So this is not one of our items that we listed out, because remember we had a few that were fairly clear criteria. We talked about the audit of internal controls over financial reporting. That requires an explanatory paragraph. Talked about going concern issue. We talked about lack of comparability or lack of consistency. So this one's talking about related parties. So that if anything, this would be an other matter. The question is do you think this is significant enough to be included as an other matter item? What do you all think? Do you think that a series of related party transactions, so significant transactions with related parties? This is a judgment call right here, okay? You could make the argument, no, this is not particular an issue. It's not particularly an issue. Now, we do not even include the paragraph. Now, the problem is that there's not going to be there's not a statement up there that basically says this is not an inclusion that we would ever consider. It basically says it would change the opinion, which it doesn't. Okay, violates auditing standards, which it doesn't. Necessitates a revision of the opinion paragraph, which it doesn't. Okay, these are just disclosures. It's disclosure of particular information, but it doesn't change our opinion. So the only logical conclusion we can come to is that it is appropriate. It would not negate the unqualified opinion. Now, how do we know that it does not change the opinion? Simply because it does not mention specifically a departure from GAAP or a scope limitation, which remember, those are our two criteria for issuing something other than an unqualified opinion. This is going to be something that kind of walks the line if we're talking about related party, but if the clients treated those related party transactions disclosures properly, they have not violated GAAP. So that's why we're going to say we can go ahead and include an explanatory paragraph. That makes sense. Question number 13. Eagle Company, a public company, had a computer failure and lost part of its financial data. As a result, the auditor was unable to obtain sufficient audit evidence related to Eagle's inventory account. Assuming the inventory account is at least material, auditor would most likely choose either what? Now, this is an interesting question. I do want to set your mind at ease. When looking at questions like this, particularly in this course, and then on exams that might be related to this, questions about related to this, oftentimes you will see a criteria that will ask you to choose between different types of reports that could be issued. They are trying to identify what is the nature of the violation, not necessarily the severity of the violation, okay? Because remember, we have to, in order to determine the severity, we have to determine between material and pervasive. And oftentimes that's a really, really difficult judgment to make unless they tell you specifically it's a pervasive violation or it's a material but not pervasive violation. In this case, we don't know, okay? We don't know, is the scope limitation going to be a material scope limitation? Is it a pervasive scope limitation? We're not sure what it is. So we're going to have to choose between one of two options that represent a scope limitation. So what would that be? Okay. Well, the first option is obviously a qualified opinion because that's for any issue that we have. But what do we call it when there's a pervasive scope limitation? What is that called? Or what type of opinion do we render? Disclaimer of opinion. So it's going to be either choosing between a qualified opinion or a disclaimer of opinion. That actually identifies the nature of the violation, but it doesn't identify, it's not specific as to the severity of the violation. And those are going to be common types of questions that you would see with regard to these types of this type of issue. 16. King CPA was engaged to audit the financial statements of Chang Company, a private company, after its fiscal year ended. King, so this is interesting because we're talking about private companies, which we've only focused on public companies, but the rules are going to be largely the same. King neither observed the inventory count nor confirmed receivables by direct communication with the debtors, but was satisfied that both were fairly stated after applying appropriate alternative procedures. Now, we've not talked about this. We're going to talk a little bit about this when we get to the next section, but alternative procedures, what do those represent? Well, for each of the accounts that we're going to be testing, and each of the items that we're going to be testing, we're going to develop routines to test those items. We're going to say, this is a way that we could test these particular transactions, or that we could test these account balances. In some scenarios, we may not be able to do what it is we want to do. For example, let's say that we joined the audit too late and we did not have any staff on place that could watch the inventory count. That's not a procedure we can perform. So we're going to come up with additional procedures that we could do, additional, which are called alternative procedures, that do not provide as high levels of assurance, but still give us evidence regarding the account balance or the transaction. That is what this is referring to. It's basically saying this is a substitute for what we'd like to do, but we can't do given the circumstances. So the key words here is that we were satisfied that both were fairly stated. All right. If we have fairly stated, we're applying there are no material misstatements. Therefore, King's financial statement audit report would most likely contain a what? So it's going to be an unmodified opinion because that's what we call an unqualified opinion for private issuers. But do we need to add an emphasis of matter paragraph? Not really. Okay, not really. We don't need to add any additional information because we did our job to the best of our ability. We applied appropriate procedures, alternative procedures. We don't need to go into details to what those were. Okay. So yeah, DC is our answer. C is our answer. I said DC, but C is our answer, not DC. C is our answer. Question 19. Which of the following best describes the auditor's responsibility for other information included in the annual report to stockholders that contains financial statements in the auditor's report? So remember, we talked about that. We looked at a picture of McDonald's, front page of McDonald's financial statements, which had a picture of a Big Mac on it. And I said, isn't that beautiful? It's the most beautiful Big Mac I've ever seen. Okay. That's like a work of art. People put that in the middle of the Truman Court or the Truman Quad, and they would come by and admire it because it was so beautiful. Remember, annual reports are sunshine and rainbows. They try to put the best spin on the organization. Do we have a responsibility to audit the information in the financial statements? No. But we do have to make sure that the information that's presented from the audited financial statements is consistent with what's reported. You can't go saying we had $1 billion in revenues when they had $10 in revenues. That's a misrepresentation. So we do have to make sure the information is correct. So let's go ahead and look through the answers. The auditor has no obligation to read the other information. Well, we do. We do have to read the other information. Auditor has no obligation to corroborate the other information, but read the other information to determine whether it's materially consistent with financial statements. That sounds more consistent with what we were talking about. That sounds more correct. So B is going to be our answer, but let's look at the rest. The auditor should extend the examination to extent to verify the other information. Again, we're not auditing that information, or we're not testing it. Okay. Auditor must modify the auditor's report to state the other information is unaudited and not covered by the auditor's report. Did at any point in time when we talked about this say that we had to modify the auditor's report? No. Okay. Don't add procedures that never existed. Don't add an additional tasks that we never talked about. Sure sounds like a good one. So yeah, well, let's just be safe. Let's modify the audit report. No, not going to do that. Okay. We're just checking to make sure the information is correct. All right. Chapter 21. 16. Which of the following professional services would be considered an attestation engagement? This is an interesting question because we're looking for one of those 6 service types that we talked about. Let's review what we talked about on Wednesday. Okay, 6 services, agreed upon procedures, prospective financial statements, pro forma financial statements, compliance, MD&A, SOC. Okay, so we're looking for something that falls within that. So management consulting engagement provide IT advice to a client. Boy, that sure sounds good, but it's not one of those 6 procedures. And engaged to report on compliance with statutory requirements. There's that word compliance, which is one of those procedures. So it's likely B, but let's look at the rest. An income tax engagement to prepare financial state tax returns. Preparation engagements are not SSA are not SSAE engagements. They're not attestation, they're assurance. Preparation of financial statements from client's county records. We just talked about that. Okay. So C and D are out because they're SSARS, and A is not one of the 6 services we talked about. So B is our clear answer. It's the only one that lists the service we talked about. An accountant may accept an engagement to apply agreed upon procedures to prospective financial statements, provided that what? Okay, so let's just go through the answers and see what we identify. Okay. An examination is also performed on the prospective financial statements. So if we're going to perform agreed upon procedures on the prospective financial statements, we also need to do an examination. That kind of defeat the purpose, do you think? What's the point of doing the agreed upon procedures if we're just going to support it with a much more effective procedure? Because remember, examinations are like audit level procedures. Okay. Why do we even bother with agreed upon procedures? It's much lower scope of procedures. There's no point in trying to say, well, we're going to do something that's really simple, but we're going to support that with something really, really complicated and complex. Why don't we just do the complicated and complex in the first place? Doesn't make any sense. Responsibility for the adequacy of the procedures performed is taken by the accountant. Do we take responsibility for agreed upon procedures? No, okay, because we are not issuing an opinion. We're not rendering any detail. We're just basically saying, okay, we're going to perform these tasks and we'll report on that. Negative assurance is expressed on the prospective financial statements as a whole, okay? So do we provide any assurance in agreed upon procedures? No, remember that was our hierarchy. We said examination, reasonable assurance is the highest level opinion. It's basically the same as an audit. Negative assurance is a review. No assurance is going to be what we do for agreed upon procedures. The engaging party acknowledges the appropriateness of the procedures before the practitioner issues the report. What do you guys think about that one? That sure sounds like a correct answer, and that's the only one that's left that makes sense. Okay, so yeah, engaging party acknowledges the appropriateness of procedures where the practitioner issues a report. Okay. Question number 20. Yes. Which of the following statements is correct concerning both an engagement to compile and engagement to review a non-public entity's financial statement? So these are SSAR questions. And so they're asking, what is the similarity between compilation and a review? So let's just go ahead and go through these again. The accountant is not required to obtain an understanding of internal control. Is that true for a compilation? It is true. There's no responsibility for control in a compilation. Okay. Is it true for a review? It's also true for a review. Remember, that was one of our big differences. That was one of the ones I anchored on really, really heavily when we talked about this on Wednesday. Said review, no control, which automatically makes reviews worse than auditing because controls are great, but we don't have to test controls in a review. Okay. So A is our answer, but let's go through the rest. The accountant must be independent in fact and appearance. Do we need to be independent for a compilation? Give you a hint. It's either yes or no. For a compilation, we do not need to be independent. Is there a caveat to that? Yes, if we are not independent, then we have to make sure that we disclose that in our reports. Now, we do have to be independent for a review, okay? So those are something they do not share. Accountant expresses no assurance in the financial statements. Do we express any assurance in a compilation? No assurance is expressed in a compilation. We do not provide an opinion. We do issue a report, but we do not issue an opinion. Do we express any assurance in a review? Yes, we do. What is that assurance type called? Negative or limited assurance. Negative or limited assurance. Good. The accountant should perform inquiries and analytical procedures. Do we perform any types of audit testing in a compilation? We're the ones compiling the financial statements. Doesn't make any sense that we would be testing the financial statements. It's like, I'm just going to check my own work. Yeah, okay. Nope, we don't perform any testing in a compilation. Do we do these types of testing for a review? Yes, and it's important to note that these are the only types of testing we perform for a review, inquiries and analytical procedures. So yeah, this question, not a particularly difficult question, but there's a lot to it, a lot of important points to review in that particular series. That's why I chose this question, even though it's not particularly hard. All right. Let's say we get to the fun stuff. Heard you like subsequent events. Anybody just really excited about talking about subsequent events? So here's what we're going to do. For each of these questions, I am going to ask you three considerations, okay? First, is it a subsequent event? Some of these we're going to answer no, okay? So if that's the case, we're going to stop there. If it's no, we're just going to stop there, which means I'm only going to ask you one question. So if the answer is yes, you're going to tell me what type 1 or type 2. And then if it's a type, depending on the type of report, we're going to talk about what do we need to do, what do we need to insist upon as auditors that the client do, the client do and does do whatever the client performs in response to the subsequent engage or subsequent event. There we go. It's a problem with getting old. You lose your train of thought and it's hard to get back on. It's like jumping off a train and the train is still moving full speed and just can't get out of the thoughts. Don't get old. That's my advice to you all. Don't get old. So, but Dr. Barnes, if we get older, we have money. I said, that's fair. It's fair. But it takes, there's a trade-off there. There's definitely a trade-off. All right. A large account receivable for an Agronowitz company, material to the financial statement presentation was considered fully collectible at December 31st, 2024. Agronowitz suffered a plant explosion on January 25th, 2025. Because Agronowitz is uninsured, it's unlikely the account will be paid. All right. First question, the most important question. Is this a subsequent event? What do we believe? Yes or no? Do we have a consensus? It's yes. A lot of people are nodding yes. Would anybody really enthusiastically believe no? It's the last chance. This is a subsequent event. Yes, you are correct. This is a subsequent event. What type is it? Type 1 or type 2? So type 2, this is an unfortunate, it's not a natural disaster, but it's an unfortunate event. It's a disaster of some type because a factory exploded. Those situations did not occur at the beginning. So yeah, we did just something that came up as an incidental event. So type 2 event, what is the absolute bottom line, the minimum that our client will have to do in response to this? They'll have to disclose the nature of the subsequent event, okay? They will absolutely have to put this in their financial statements. Is there a possibility that something else could be related to this? So depending on how significant this particular client is, because it says it's a large accounts receivable, this may affect their operations in the future if they can't collect this accounts receivable. We may have to have them issue pro forma financial statements. I think it's unlikely that pro forma financial statements will be issued in this circumstance, but it's a possibility. So we're going to hold on to that. All right. The tax court ruled in favor of the company on January 25th, 2025. Litigation involved deductions claimed on the 2021-2022 tax returns and accrued taxes payable. Skornick had provided for the full amount of potential disallowances. The IRS will not appeal the tax court's ruling. All right. So is this a subsequent event? A lot less certainty on this one. Is this a subsequent event? Same hint as before. It's either yes or no. Yes, it is. It's definitely a subsequent event. This is a litigation that did get eventually resolved. So this is an example of a subsequent event. In fact, it's a primary example of what type of subsequent event. Type 1 subsequent event. So what is our rule for type 1 subsequent event? What do we have to insist the client does? Just the financial statements, okay, to reflect the effects of the ruling. The effect reflects the subsequent event. Yes. Skornick's manufacturing divisions, whose assets constituted 45% of Skornick's total assets on December 31st, 2024, was sold on February 1st, 2025. The new owner assumed bonded indebtedness associated with this property. So sold a very large part of the corporation before the issuance of the financial statements. What do you think? Subsequent event? Well, what's the definition of a subsequent event? Something stakeholders will want to be aware of so they can because it might affect their decision making. Do you think selling off half the company might affect the decision maker's use of the financial statements? Yeah, so I think this is probably a subsequent event. This is probably a subsequent event. Type 1 or type 2? Type 2, okay, it did not exist at the financial statement dates or the balance sheet date, so we can go ahead and say it's a type 2 event. All right, so we know type 2 event, disclosure, bare minimum. Do we think we're going to have to issue pro forma financial statements in this situation? For selling 50% or 45% of the company, sorry, I'm overstating. For selling roughly half the company, yeah, probably is going to affect our operations in the future. So we probably would want to issue pro forma financial statements. On January 15th, Ari Vogler, a major investment advisor, issued a negative report on Skornick's long-term prospects. That was not very nice of him. The market price of Skornick's common stock subsequently declined by 40%. Wow. Oh my gosh, that's pretty significant. Is that a subsequent event? See a few heads shaking. Anybody want to argue that this is a subsequent event? Anybody want to take a really firm position on how they viewpoint this? So does market price of stock affect our financial statements? It does not. Market price of stock does not affect financial statements. There is no reporting effect of this particular item. So this is not a subsequent event. This is not something that would go in the financials. We can just ignore it. At its January 5th, 2025 meeting, Skornick's board of directors voted to increase substantially the advertising budget for the coming year and authorized a change in advertising agencies. Is this a subsequent event? It'd have to be a pretty big change in advertising agencies for this to be a subsequent event. This is one of those ones I'd be like, as an auditor. Number 4 is kind of like panic mode. It's like subsequent decline of 40%. This is awful, but it doesn't affect the financials. That one is a little bit less clear. This one's pretty obvious. 5, not a subsequent event. So we can ignore it. So these are good examples of the types of questions that I might ask you in this area. If it's a subsequent event, and if so, what type? You can kind of see the template that I would use for that. All right. Moving on to chapter 18. We got a lot of fun stuff in chapter 18. Okay. So for each of the following independent situations, indicate the type of financial statement audit report that you would issue and briefly explain your reasoning. Assume that each item is at least material. Okay. So by the way, in lieu of any other information, assume that any situation I give you is going to be a publicly traded company, unless it specifically says a privately traded organization. Okay. But we can go ahead and just use that as our template here. So Bearfield Corporation, a wholly owned subsidiary of Sandy Incorporated, is audited by another CPA firm. As the auditor of Sandy, you have assured yourself of the CPA firm's independence and professional reputation. However, you are unwilling to take complete responsibility for its audit work. This is a prime example of one thing we talked about. It's the only scenario that this comes up. So first of all, what is the opinion that we would issue here? The opinion will be different. Absence of any other information, this is an unqualified opinion. What is the one modification we might have to make? We have to add modified wording. This is the example of modified wording that we talked about on Monday. Example of modified wording. Remember, we talked about what if there's other auditors we're not willing to take responsibility for their work. We have to modify the language to include that phrase based on our work and the work of other auditors to specify that we are not wholly responsible for this work. The management of Bonner Corporation has decided to exclude the statement of cash flows from financial statements because it does not believe the bankers find the statement to be very useful. I mean, let's be honest, the statement of cash flows, Enron did that and they came out completely fine, you know? Yeah. So statement of cash flows required by GAAP. It is required under generally accepted accounting principles. And you don't get to use the excuse, Dr. Barnes, I'm not taking financial statement courses this summer. I don't remember any of the financial accounting. I don't remember financial accounting rules. You do have to remember those for this course, okay? So statement of cash flow is required under GAAP. This is a departure from GAAP, which means it's going to be at least what? Least qualified. And if we think it's really significant, it's going to be adverse, okay? Qualified or adverse, one of those two. You are auditing Diverse Carbon, a manufacturing nerve gas for the military for the year ended September 30th. On September 1st, one of its manufacturing plants caught fire, releasing nerve gas in the surrounding area. 2,000 people were killed. Another more so they're paralyzed. Gosh, that's gruesome. Company's legal counsel indicates the company is liable and the amount of the liability can be reasonably estimated, but the company refuses to disclose this information in the financial statements. So they are liable, so it's probable, it's reasonably estimable. Does that follow our rules for contingent liabilities? Yes. What's the requirement under those guidelines? Probable and reasonably estimable. Is it disclosure or accrual of the liability? So probable and reasonably estimable means that it has to be accrued. Okay. There has to be a journal entry for it. The company is saying we do not want to book a journal entry for this. Is there a reason why they might not want to book the journal entry? If this is going to go into court, does booking the journal entry kind of admit that they're at fault? Yeah, that's one of the problems with contingent liabilities related to lawsuits is that they fight those pretty heavily. But we believe as the auditors, look, there is no way you're getting out of this. You're liable for this. You're going to have to book the journal entry. If you don't do it, it's a departure from GAAP, which means it's going to be either qualified or in all likelihood, adverse. In all likelihood, this is going to be adverse. When we talk about 2,000 deaths, that's probably going to be a pretty significant concern. During your audit of Kucha Coal Company, the controller, Tracy Tricks, refuses to allow you to confirm accounts receivable because she's concerned about complaints from her customers. You are unable to satisfy yourself about accounts receivable by other audit procedures, and you're concerned about Tracy's true motives. There's a lot of alliteration in that paragraph right there. Tracy's true motives. Yeah. So let's go ahead and ignore Tracy's true motives for the moment. But What do we call this when we can't do our job? Scope limitation. So this is going to be at least a qualified opinion. It could be a disclaimer opinion if it's can be a big concern. Could the possibility of fraud existing in this situation really affect our approach to this? We would definitely want to report this to upper management, the audit committee, especially, so we're talking about the controller, probably want to report this to the CEO and CFO. Like, even if if we can't prove fraud, we'd say, look, there's no reason why we shouldn't have been able to look at that financial statements. Probably also want to report this to the audit committee as well, because if the CEO and CFO are knowledgeable about this, then they might try to disguise this. But this is one of those areas where I would want to take additional actions with management and the audit committee to make sure that they knew about this. And yeah, we can't issue a clean opinion in the situation. Too much of a scope limitation. On January 31st, the Sorry Toys Manufacturing hired your firm to audit the company's financial statements for the prior year. You were unable to observe the client's inventory on December 31st. However, you were able to satisfy yourself about the inventory balance using other audit procedures. This one's a pretty easy one. What is this? This is almost the same examples we talked about in our multiple choice questions. This is alternative audit procedures, and they revealed that everything's good. So we're going to say unqualified. Unqualified. Very good. Gelato Brothers leases manufacturing facility from a partnership controlled by the chief executive officer and major shareholder of Gelato. Okay, what does this represent? A related party transaction, or related party transactions. Your review of the lease indicates that the rental terms are in excess of rental terms for similar buildings in this area. That's a big red flag. The company refuses to disclose this related party transaction in the notes to the financial statements. Now, ignoring our responsibility in the review to say basically tell upper management and audit committee, this is not a arm's length transaction. It does not even represent an arm's length transaction or come close to it. What is the responsibility of any organization with respect to related party transactions? All related party transactions, not just the ones that are unfair, but all related party transactions. All related party transactions have to be disclosed in the financial statements. They are saying we refuse to let you disclose this related party transaction. Therefore, we as auditors are going to say you are in violation of, it's also the name of a clothing store, GAAP. Okay, you're in violation of GAAP. Okay, so they depart from GAAP. This is going to be a qualified opinion or likelihood an adverse opinion given the severity of this particular issue. Johnstone Manufacturing Company has used the double declining balance method to depreciate its machinery. During the current year, management switched from a straight line method because it felt it better represented the utilization of the asset. You concur with the decision. All information is adequately disclosed in the financial statements. All right. So we're talking about a change in depreciation methods. What do you guys think? Is it going to affect our opinion issued? No, this is going to be an unqualified opinion. Do we need to add anything else? Is this going to be an explanatory paragraph? This is one of those ones where you have to go back to financial accounting. It says, what does a change in accounting principle do? Remember, depreciation is weird because it's going to be a change in estimate derived by a change in principle. And it does require us to go back and retroactively restate the financial statements. Okay. If that's the case, that's going to be affected. It's going to affect the comparability of the financial statements. What do we know when comparability is affected? We have to issue an explanatory paragraph. We have to include an explanatory paragraph in the report. So this is unqualified with an explanatory paragraph. All right, let's do a few more. What do you say? What do you say? This next one I really like, though you may have to do some research. Anybody do extensive research for these particular questions? Uh-oh, here we go. Abadi Mines issues LIFO for value inventory held in the United States and FIFO for inventories produced and held in foreign operations. This is where you have to do some research. You're going to get like, why did they use LIFO in both? Why do you think they didn't use LIFO both domestically and abroad? It's going to let you know about it, international accounting rules. LIFO is not legal under IFRS. Interesting story. So what is the rule here? The rule is that if it's something that's legal in the United States but not legal abroad, you can use different methods. Okay, different methods of reporting. So they used FIFO and LIFO. Is that okay? The answer is yes. This is perfectly fine. So we're going to issue a qualified opinion. But you could only answer that if you knew that rule, which means that you had to do some research as auditors. And if you didn't do research, you probably said qualified opinion. Nope, it's not qualified. It's unqualified. Don't worry, I won't ask you to do research on the exam, mostly because I don't want you to have that tool at your disposal. All right. Walker Computers is suing your client Super Software for royalties over patent infringement. Super Software is outside legal counsel assures you, and you agree, that Walker's case is completely without merit. Super Software does not disclose any contingencies related to the case. So we're talking about this particular contingent liability is remote possibility. It's very not probable. It's not even reasonably possible. It's remote. Do we have to disclose that? Or does our client have to disclose that, I should say? No, they don't have to disclose it. They don't have to issue an accrual. They don't have to do anything. Therefore, we're just going to issue an unqualified opinion because there's no reason to change what they've done. All right, in prior years, Worcester Wool Mills has used current market prices to value its inventory of raw wool. During the current year, Worcester changed to FIFO valuing raw wool. This is kind of interesting. So what do we know about these two inventory methods? So Dr. Barnes, they're both completely legitimate under GAAP. Is that a correct statement? How many of you remember back in 220 and learned about FIFO? Did we remember learning about FIFO, saying FIFO? Yeah, first in, first out. It's the name of Dr. Caden's dog. Yeah, it actually is. Yeah. What about current market prices? Is that a legitimate inventory method under GAAP? It is not. Okay, it's not something you learned about in 220. It sure sounds good, but it's not legitimate. So this looks like this is a change from a non-GAAP method to a GAAP approved method. So how do you feel about that as an auditor? Are you kind of like, how dare you use a non-GAAP method in the years before this year? It's like, well, we're fixing analysis. Okay, that's good. That's good. So if we're going to say this is an unqualified opinion, do we need to add an explanatory paragraph? Yeah, we're doing a change in accounting principle. Plus, it's pretty obvious that if we're changing from one inventory method to another, it would affect comparability. So explanatory paragraph would need to be added here. Upon review of the recent history of the lives of specialized service trucks, gas leak technology justifiably changed the service lives for depreciation purposes on trucks from 5 years to 3 years. The change resulted in a material amount of additional depreciation expense. All right, change in opinion here? No, this is still an unqualified opinion. Do we need to add an explanatory paragraph? What are the two words? Two words we always use in accounting classes when we don't know the answer. It depends, okay? The answer is it depends on whether this will affect comparability in the period or not. So if we use just straightforward accounting rules, the answer is changing depreciation useful life is a change in estimate, which does not require a retroactive adjustment. So if we follow those rules, no, we don't have to use, we just issue an unqualified opinion, no explanatory paragraph. But it says in the problem, a material amount of depreciation expense. Is that likely to affect comparability from one period to the next? I would argue yes, okay? So in my situation as an auditor, I'd say, I know that this is just a change in estimate, but I think it affects comparability enough that I would want to issue an explanatory paragraph. Now, the good news is, if you answered this question on the exam, you have 3 possible correct answers. You have unqualified opinion, you have unqualified opinion with an explanatory paragraph, and you have unqualified and it depends, Dr. Barnes. Okay, all 3 of those would be legitimate answers. You just have to justify why those are legitimate answers. During the audit of Kwame Bakery equipment, you found a material amount of inventory had been excluded from the company's financial statements. After discussing this problem with management, you became convinced that it was an unintentional oversight. Management appropriately corrected areas of error prior to your finalization of field work. What do you guys think? So they tried to hide inventory from you. They hid inventory from you. You knew you were quick and discovered it, and they were like, "Oh, we didn't know about that. Our bad." Okay, but you're like, "Okay, this was not intentional." So do you think that there's any malfeasance going on here that you need to change your opinion? Nah, this is an unqualified opinion. This is pretty straightforward. This is pretty easy. All right. Jay Rich holds 10% of the stock in Rothenberg Construction Company. The board of directors of Rothenberg asked Rich to conduct its audit. Rich completes the audit and determines the financial statements present fairly in all accordance with generally accepted accounting principles. So yeah, free from material misstatements. So this is an unqualified opinion, right? Tommy, why are you shaking your head at me? Lack of independence, you're absolutely right. What does that mean? Yeah, so can the CPA issue an opinion? No, what do we call it when we don't issue an opinion? Disclaimer of opinion. Lack of independence is one of those really niche rules. If you do the audit, but you're not independent, you can't issue an opinion, you have to disclaim an opinion. So it doesn't matter how great the financial statements are, no opinion may be rendered by a party that's not independent. All right. Ramamuthri Savings Loan financial condition has been deteriorating for the last 5 years. Most of its problems result from loans made to real estate developers in St. Johns County. A review of the loan portfolio indicates there should be a major increase in loan loss reserve based on your calculations. The proposed write-down of loans will put Ramamuthri in violation of the state's capital requirements. Client refuses to make the adjustments or disclose the possible going concern issue in the notes to the financial statements. Let's take these independently, okay? So first of all, fail to make an adjustment. What are we going to conclude if we're the auditor here? The financial statements are what? Are they free from material misstatement? They are not free from material misstatement. Therefore, it's going to be at least a qualified opinion, if not an adverse opinion. So that in and of itself is a directive, but let's ignore that, okay? Let's just say that they make the adjustment, but they refuse to issue or refuse to mention the going concern issue, because that's another separate issue. Basically, we've identified that they may not be in business a year from now. Is that a problem? Yes. So they are required, if we think that there's substantial doubt about their ability to continue as a going concern, they're required to disclose this in the financial statements. If they do so, we would issue an unqualified opinion with an explanatory paragraph, okay? This is again assuming that they make the adjustment and there's no other violations present, all right? What if they make the adjustment but fail to disclose the going concern issue? That is also a violation of general accepted accounting principles. That's a situation where a going concern issue would result in a change in opinion, not because of the going concern presence of the going concern issue, but the failure to disclose it. These are two separate issues. Keep that in mind. A going concern issue by itself does not change the opinion. Failure to disclose the going concern issue is what would result in the change in opinion. Okay. In either situation, both of these are going to be present, and so this is very clearly a problem. So I'm likely going to be an adverse opinion. I would bet on this being an adverse opinion if this existed in reality. All right. Last questions. This is kind of an interesting question. I threw this last question in late, and I've done this for a few years now, and I think it's a very interesting one. So Orange Grove Farms has approached your CPA firm with some questions. Orange Grove's management has spoken with the bank about obtaining a loan to expand its operations. Or the bank has informed Orange Grove the bank will not make the requested loan until the company submits financial statements. Further, the interest rate on the loan will depend on whether Orange Grove's financial statements are compiled, reviewed, or audited by an independent auditor. Orange Grove's management is not familiar with the differences between these three services and wonder why the interest rate charged on the loan would depend on the type of service they obtain from your CPA firm. This is an interesting question. This kind of ties everything together. All right. So I want you to explain the difference between compilation, review, and audit engagement to include the level of assurance as each one is part of your explanation. So let's just go ahead. Compilation, we as the CPA are putting together the financial statements based on representations by management. How much assurance are we providing in this scenario? On a scale from 0 to 10. 0. We're providing zero assurance. No assurance is provided in a compilation. We're just doing the job on behalf of the client. On a review of financial statements, we're performing limited procedures to verify the financial statement information. Okay. This is going to include inquiries and analytic procedures, no test or controls. Okay. Minimal types of testing, just making sure that the information is succinct and correct. Okay. What about the level of on 0 to 10? What would we say? Probably about a 5. Okay. Right in the middle. All right. What do we say? What type of assurance do we talk about in a review? Limited or negative assurance. Okay. We are not aware of any material modifications that need to be made. All right, then an audit. Audit, we're detailed testing of the financial statement balances and transactions to make sure that financial statements are free from material misstatement. What about a level of assurance from a scale of 0 to 10? Probably a 9 because we can't achieve 10. 10 is that absolute assurance, okay? Very high level of assurance. Now think about this. If you're a bank and you're issuing a loan, and you're saying our interest rate is going to depend on what type of engagement you have, are you going to issue a higher or a lower interest rate for high levels of assurance? So remember, risk and rates are associated with each other. For higher risk, you get higher rates. For lower risk, you get lower rates. If I have audited financial statements presented to the bank, are you going to assume more risk or less risk? I'm going to assume less risk because I have a lot more information about detail about the organization. So less risk in that case. If that's the case, lower risk means lower rates, lower interest rates. Compare that to a compilation where I provide financial statements and we have no idea if they're correct or not. The CPA just compiled them based on what management told them to put in there. What is the risk associated with that comparative to the financial statements? Much higher, okay? As we know, risk and rates are going to be directly associated, so our interest rates are going to be higher. So the more assurance we provide, the lower the interest rates we can assume. Does that make sense to everyone? That's why organizations will voluntarily go into audits because banks will tell them we will provide you with a lower interest rate on the loan if you can provide audited financial statements. What if the bank tells you that and you don't provide audited financial statements? What are they going to say? It's kind of a signaling theory question. This is basically to say, well, they didn't provide audited financial statements. Their financial statements must be a mess. They're a mess, there's higher risk, and they're going to say 10% interest. We actually had a talk about returns in my AIS class. Anybody willing to pay 10% interest on a loan? Hopefully your answer is no. Hopefully your answer is no. So I'm going to go ahead and get that audit done so I can actually pay a reasonable amount of interest. And with that, we've finished another week. Week 10 is upon us. We got an exam next week. Please make sure that you finish the reviewing the study guide and you review the practice exam. We will do that on Monday. Have a good weekend.